All right, so in this video, I'm going to talk about dividend-based valuation for common stock. So if we have a common stock that pays dividends, and if we assume that the value of the stock and the price of the stock are the same for now, then the expected price or value of a share of common stock which pays dividends is going to be the present value of all expected future cash flows. And really, that's just sort of a general principle for valuation. The value of any asset or investment is the present value of all expected future cash flows. So in this case, if we're looking at a stock that pays dividends, the cash flows that we have are the dividends. And if we sell it at some point, then the proceeds from the sale. So what we're going to do is we're going to take the future dividends. So this DT, we're looking at each dividend. So T is just to keep track of the period. And I'm going to, so D1 would be the dividend at the end of the first period, D2 dividend at the end of the second period, and so forth. So I'm going to take the future dividends, I'm going to divide it by 1 plus the required rate of return raised to the T. So that dividend is a future value. So I'm taking a future value divided by 1 plus a rate raised to a power. So what that is getting us is the present value of that future dividend. So I'm going to find the present value of dividend 1, present value of dividend 2, present value of dividend 3, and then we're going to sum those all up. So this is just a fancy way of saying we're going to sum all those future dividends up between now, or really between this next period, and N. N is going to be the point in time in which the stock is sold. So I'm going to find the sum of all the present values of all those future dividends between now and whenever we sell the stock. Then we also need to account for the fact that we sold the stock. So when we sell the stock, we're going to sell it for some price, which I'm reflecting that as P subscript N. So that means that's the price we're going to sell it for at time N. But that's in the future, so I need to find the present value of that. So I take that P subscript N divided by the 1 plus the required rate of return raised to the N number of periods. So this whole term is finding the present value of what we sell it for. So ultimately, all this formula is doing is saying, I'm going to find the present value of every dividend, present value of what we sell it for, and I'm going to add all of it up. Okay, so the present value of all future dividends between now and when we sell it, present value of the price that I sell it for, add all those present values together, and that should give me the price, which if we're assuming is the value at this point. So, so basically all we're doing is just finding present value here. All right. Now, a few little notes here. So RS is going to be that required rate of return, and that's going to be company specific, and it's also going to be affected, therefore, by company specific factors, but also economic factors. So if interest rates in the entire economy rise, then it would be logical to conclude that investors are going to expect their returns on stocks need to be higher in order to compensate them. And similarly, if there was a situation where news came out that made investors think the company is more risky than it used to be, investors would now require a higher return to compensate for the risk. So then RS would need to go up. And if you look at the formula, if RS goes up, all of these present value terms shrink. And so therefore, the expected price or value goes down. So basically, as the discount rate goes up, the expected value goes down. Now, if you held the stock forever, then you'd never have a sale price, right? So you'd never have a price you sold it for at some point in the future. And N would now be infinite because you just buy the stock and just hold it forever. So if I make those changes, basically what we get down here is the present value or the expected price for a share of stock that pays a dividend, if I buy it and hold it forever, is just the present value of all future dividends. So I just find the present value of every single dividend, add all of those up, and that would give me what the expected price would be. All right, hopefully that kind of sets the stage a little bit for dividend valuation. And thank you so much for watching, and have a great day.